All right, happy Monday, Accounting 651. Let's complete our Chapter 6 video lecture over the next few minutes. And as you know, we've walked our way through some of the classic redemption cases so far, and you've been working on a case that involves this next topic, which is a complete termination of interest. Okay, so under 302b3, a termination of the entire interest of a shareholder generally qualifies for sale or exchange treatment. So this often would be something that would not qualify as a disproportionate redemption due to the stock attribution rules. So, for example, if John owns 100 shares of R Corp. And Allison, John's daughter, owns 50 shares of R Corp. And Chuck, Allison's son, owns another 25 shares of R Corp. And R redeems all of Allison's stock, it would meet the substantially disproportionate test because her ownership would go below 50%, which certainly means that it's more than a reduction of 80% or 20% reduction. But the attribution rules prevent that from happening. So we need a way for a family member to be able to escape from R Corp without disguising a dividend as a sale. And so we need to prevent. Well, there's two conditions, right? Think of it this way. The first is, one of the conditions is you have to prevent that redeeming shareholder from being able to exercise any control over the corporation. Because if you can't control, then you know that maybe you really have sold, right? We've seen that with 50% rule and the disproportionate reduction rules. And also, we need that shareholder needs to avoid pre-planning the disguised dividend, which is taking steps before the redemption to try to disguise the complete termination as something that it's not. So the rule says that these family attribution rules, and only the family attribution rules, will not apply if the former shareholder has no interest other than a creditor for at least 10 years. So they can't be a director, they cannot have a price that's contingent on the performance of the corporation as part of the redemption. They certainly cannot be a continuing employee. And this can happen if it's related to a shareholder death. So, for example, if we had a change in ownership because someone died and left shares, then that would be okay. So you are required to notify the IRS of any disallowed interest within the 10-year period. And if that happens, then you have to pay the tax and any interest. So this applies, again, only to the family attribution rules, not the other types of attribution. There's also, you're prohibited from having any preceding transfers that are in anticipation of the redemption. So any of the redeemed stock that had been transferred between family members in the previous 10 years may affect that decision. So if, for example, the shareholder gifted some to their children or put some in a trust within 10 years prior to that redemption, then there could be a problem. So the purpose of looking back the 10 years is to prevent these anticipatory transfers that have no reason besides tax avoidance. So, for example, assume a sole shareholder wants to make a cash gift to his son by giving the son some of his stock and then having the corporation redeem the son's stock shortly afterward. The distribution and redemption would be treated as a dividend in this case, not in exchange for stocks, since the attribution of the father's stocks, ownership of the son can't be waived. So a sole shareholder will have a dividend if he gives his wife half his stock and his half is redeemed to withdraw cash from the corporation. So if, for example, Corp X stock is owned equally by Mitt and the Mitt Family Trust, and as it turns out, Mitt's daughter is the sole beneficiary of the family trust. If the trust shares were completely redeemed, the redemption would not qualify under this rule because Mitt's shares are attributed to Mitt's daughter and then reattributed to the trust. And so as a result, that interest remains. So what would need to happen is the trust and the daughter would need to execute a notification agreement in order to receive a waiver, which means that given certain steps, you can receive a waiver on this sort of thing. Okay, So a partial liquidation. Now, this is not the same as a complete termination, although it can be. So Sunrain Corp has 3 shareholders, Al, Betty, and Carol. And Sunrain operates 2 businesses. The first is a suntan lotion business. The second is the umbrella business. So unfortunately, Sunrain's umbrella factory burns to the ground. The good news is Sunrain has adequate insurance and receives a large insurance payment. And Al loved the umbrella business, but Betty and Carol determined that the California drought is coming back and decide to exit the umbrella business. Thus, the insurance proceeds are going to be paid out to Al as he leaves. And a portion will end up with Betty and Carol as well. And the question is this a dividend or is this a legitimate contraction of the business? So how do you deal with the situation when there is a partial contraction of the business? Because a partial contraction means that a portion of that business is liquidating. This is not a redemption. This is a part of the business is being liquidated. And so think of that as a part of the business is basically being sold. So the alternative might be to liquidate all of the corporation, distribute all of the property of the corporation, and then have the folks that want to continue recontribute that property to the new corporation. One of the problems is on that liquidation, the corporation is going to be required to recognize any gain on the complete liquidation of that property. So if any of the property is appreciated in value, the corporation is going to recognize gain and have to pay tax, which means that that is not a frictionless exit and re-entry into the business. So fortunately, the code allows something known as a partial liquidation. And it says a distribution shall be treated as a partial liquidation if, of course, the distribution is not essentially equivalent to a dividend. And in this case, we're going to look at that at the corporate level rather than the shareholder level. And the distribution is pursuant to a plan and occurs within the taxable year in which the plan is adopted or within the succeeding taxable year. So that means that this partial liquidation has to be pursuant to a plan and it needs to occur fairly quickly. So termination of a business. The distributions which meet the requirements of the previous paragraph shall include a distribution which meets subparagraph A and B. So what are these subparagraphs? A, the distribution is attributable to the distributing corporation's ceasing to conduct or consists of the assets of a qualified trade or business. Or B, immediately after the distribution, the distributing corporation is actively engaged in the conduct of a qualified trade or business. Okay, so think of these 2 requirements as there needs to be a cessation of business, and then after the distribution, that corporation must continue to operate in some way, in some trade or business. So that means there needs to be both a ceasing of business and a continuation of business. So the non-corporate shareholder gets this magical sale or exchange treatment for a partial liquidation. So the distribution is not essentially equivalent to a dividend. And so under the safe harbor rule, if the distribution is pursuant to a termination of an active business, it should meet the not essentially equivalent to a dividend. To qualify it, the distribution must be made within the taxable year the plan is adopted or in the succeeding taxable year. And even though it's not required, you definitely should have a written plan. If you're going to engage in a partial liquidation and you want to get this sale treatment, it is definitely in your best interest to have a written plan of the partial liquidation. The not essentially equivalent, we're going to discuss here in a second, looks at the effect on the corporation. And basically, it requires a genuine contraction of the business of the corporation. So a genuine contraction is difficult to apply because there are no objective tests to what it means to be not essentially equivalent. And so as a result, the corporation should probably think about getting an advanced ruling from the IRS. Okay, so corporate shareholders do not enjoy the same treatment. But that's not that big of a deal since they probably get a DRD. So what we'll see is that if a corporation has a subsidiary that undergoes a partial liquidation, it's not treated the same. But that's not that big of a deal. However, recall that Section 1059 closes that down. And that's because it treats all partial redemptions as an extraordinary dividend. And therefore, a corporate shareholder is required to reduce their basis in the affiliate stock. So we talked about that not in the last video, but the one prior to that. Okay, so not essentially equivalent, the two definitions. Remember, this is one of the main ones. Focused on the shareholder perspective, that's 302B1. 302E4 is focused on the corporation's perspective and implies that a pro rata redemption could, but not must qualify. So a distribution is not essentially equivalent to a dividend at the corporate level if it results from a genuine contraction of the distributing corporation's business, or the distribution is attributable to the distributing corporation ceasing to conduct or consists of the assets of a qualified trade or business, and immediately after that corporation continues to conduct a trade or business. So this is a facts and circumstances test, and it's not real guidance. Okay, so what that means is we need to identify what's it mean to have a genuine contraction of that distributing corporation's business. So the IRS is going to look at the size of the operations before and after as a measure of whether it's a genuine contraction. And there is no genuine contraction unless there's a significant reduction in the corporation's level of business activities. So either the number of employees is lower, the number of services provided, the income, the assets, something other than just a distribution of cash to the shareholders making the corporation smaller. So, for example, a reduction in the corporation's inventory because of depressed market conditions does not qualify as a genuine contraction. However, there was a genuine contraction of the corporation's business when it sold its only business and distributed 97% of the sales proceeds. The corporation retained about 3% to buy a new business. There was a genuine contraction of the corporation's business when it changed its business operations from a full-line department store to a small discount apparel store operation. And as part of that, it discontinued 33 out of 40 departments. It reduced its leased floor space by 85%, reduced the number of employees from 275 to 20. Its sales declined 85%, and AR was reduced by over 98%. And the corporation liquidated the fixed assets and inventory of the discontinued departments for their salvage value in a series of sales. That sounds like a genuine contraction, and it is. However, there was not one where the government condemned land that owned half of the proven limestone reserves of a corporation that was in the business of quarrying limestone. So after a distribution of part of the condemnation proceeds, the corporation's production of limestone continued at the same or a greater rate during the next 3 years. And it was estimated that the corporation had sufficient reserves to maintain its present rate of production for the next 18 to 27 years after the condemnation. So that was not a genuine contraction of its business. So if a corporation uses part of the proceeds from the sale of a business property to expand its remaining business, there is no genuine contraction of the corporation's business if the expansion offsets the contraction. So if a corporation that sold one of its operating parcels of real property and used the proceeds to remodel some of its other properties, that is not a genuine contraction. There was no genuine contraction where the corporation engaged in the carnival business, sold one of its carnies. No, I'm kidding. It sold one of its 10 operating units and used part of the sales proceeds to buy equipment for the remaining units. There was, however, a genuine contraction of the corporation's business when the termination of a contract eliminated 95% of the corporation's gross income. So as a result of that termination, the corporation no longer needed the services of 3 employees, and the bank canceled a credit line. A few more. There's no genuine contraction when the corporation merely distributes assets, which does not reduce the level of the corporation's business activity. So, where a corporation which was operating a florist business distributed 2 real estate interests, which is the premises that the florist was in, that amounted to 80% of its net worth to its shareholders, but it continued its business activities by renting those premises. There was no substantial contraction of the corporation's business. A distribution by the lesser corporation of leased mining property, where the lessee, an unrelated corporation, was given the exclusive right to extract ore, that's not a partial liquidation. Where the corporation distributed its Ginnie Mae servicing rights to its shareholders, and the distribution reduced the corporation's assets, revenues, and employees by a half, that is a genuine contraction. There's a significant contraction in the capital and the business activity of a ferry company when that company distributed 3 parcels of real estate, all of which were unrelated to the ferry operation, but had been developed and rented out in the past, to 2 of its 3 shareholders. After that rental property was distributed, the company neither purchased nor owned any real property except that relating to that specific ferry operation. So because of the time and attention spent by 2 of the 3 shareholders managing the property, the court in this case concluded the ownership and management of the real property constituted a business activity of the ferry company, even though it was a minor one, and therefore it was a significant contraction. Okay, here's our last ones. A contraction of a corporation's business does not result when it disposes of income-producing property with respect to which it did not engage in any business activity. So, for example, property leased under net leases, which do not require the lessor to perform any substantial services. That was not a business line, and therefore, just because it got rid of it, that did not mean that it was a substantial contraction. The distribution of a corporation's land and building that were managed by a management company owned by one of the shareholders and leased under a net lease was not a contraction of that corporation's business. And where a corporation in the food service business leased out a portion of its land to an automobile dealer, and the gross income of the land was less than 2%, that distribution of the land did not result in a corporate contraction. Okay, so what we just went through was a long series of facts and circumstances-based tests. And so this is one of the problems with a partial liquidation due to a equivalent, or not equivalent, but a business, a contraction. So you can see that because we don't have bright line tests, all the best we have is a bunch of court cases to look at. Okay, so a distribution is treated as not essentially equivalent to a dividend if the distribution is attributable to the distributing corporation ceasing to conduct this qualified or trade business. Immediately afterward, that corporation remains engaged in the conduct of a qualified trade or business, and the corporation distributes all of the assets and or all of the proceeds from the sale of the assets of the terminated business. So a qualified trade or business means any trade or business that was actively conducted throughout the 5-year period ending on the date of the redemption of the non-corporate shareholder stock. Excuse me one second. So that rule is in place because that way you cannot acquire another corporation and then do a partial liquidation and try to get sale treatment so that certain shareholders can get out but others can remain in. So think of that as going out, acquiring a business, and then cranking through and doing a partial redemption on some of those shares. That's just not going to fly. You have to have owned it for 5 years. All right. However, if it was not acquired by the distributing corporation in a taxable or partially taxable transaction, then that's included. So we're not really to reorgs yet, but what they're really talking about is if this acquisition was done through a tax-free reorg, then you cannot have a qualified trade or business. If, on the other hand, it was a taxable transaction or even a partially taxable transaction, then that would be okay. Okay, in the case of a distribution of the assets of the business in kind, the terminated business is operated by the distributing corporation until the date of the distribution. And in the case of the distribution of proceeds from the sale of assets, the business is operated until the date of the sale and the proceeds are distributed as soon as reasonably possible after the sale. Okay, so now let's go into something a little bit more funky. And think of this as basically an exception to some of the rules. So 303 redemption is where an individual has a large investment in family-owned corporate stock. And what happens is that individual dies. And that creates a large taxable estate that needs to pay estate taxes. So rather than force the sale of that corporate stock to a third party of that family investment or force dividend treatment on them to pay taxes, you can do a 303 redemption. So this allows the sale or exchange treatment if value of the stock exceeds 35% of the value of the adjusted gross estate. So the stock of two or more corps may be treated as the stock of a single corp for the 35% test if 20% or more of each corp was owned by the decedent. And the special treatment is limited to the sum of death taxes plus funeral and administrative expenses. So think of it as, look, if we're forcing you to liquidate a part of these shares to pay for the estate taxes and to pay for funeral administrative costs, we're going to at least give you sale or exchange treatment. But you better make sure that the value of the stock exceeds 35% the value of the gross estate. Okay, so in that case, the basis of the stock is stepped up to fair market value on the date of death, and the redemption price equals the stepped up basis. Therefore, there would be no tax consequences to the estate. So 303 is a way of allowing family-owned corporations to be able to pay their estate taxes without doing too much damage to the family-owned corporation. So D's adjusted gross estate is $20 million. And let's assume that the death taxes and the funeral expenses amount to $5.5 million. And included in the estate is stock of D Corp that has a fair market value of $12 million. And D Corp has lots of E&P. So what would happen is, of course, if any of that comes out as a distribution, it's likely to be taxed as dividend. So instead, D Corp says, well, why don't we redeem $6 million worth of D stock? So what is the amount, if any, of the estate's redemption? And that's $5.5 million. So what is the amount of the dividend to the estate? Well, that's the remainder. That's the difference between the $6 million that was redeemed and the $5.5 million that qualifies as a 303 redemption. Okay, a 304 redemption. So Trump owns 100% of X Corp and 100% of Y Corp. And he wishes to get his money out of his corps through a qualified redemption. So Trump sells his shares in X Corp to Y Corp. As a result, he just extracted cash from Y in a gain transaction. So think about that again for a second. So Trump owns 100% of X and Y. And so rather than have either of these redeem his shares, he just has Y Corp buy all his shares in X Corp, and therefore he gets gain. Now think about this. Is there any change in ownership at all? Absolutely not. Trump used to own 100% of X and 100% of Y. X is now a subsidiary of Y that Trump owns 100% of. So as a result, there's actually been no change in control. So Section 304 says when one corp acquires stock in another corp from a shareholder, and the shareholder controls both of those through either direct or indirect ownership of at least 50%, 304 requires that the redemption result in a reduction of ownership interest that would satisfy one of the qualifying stock redemptions of Section 302, which is effectively a disproportionate redemption, so the 50-80, or it be a 303, which means it has to do with paying off estate taxes. If it doesn't qualify under those rules, it simply is going to be characterized as a dividend. Okay, so the problem with 304 is it starts to get really complicated really fast, especially when brother-sister corporations are involved. So that's in a case where the stock received by the acquiring corp is treated as a capital contribution. But you know what? What we're going to do is we're just going to wave our hands at the rest of 304 because it does start to get too complicated too fast. And I know some of you people aren't tax people, and it's simply not fair to you. Okay, so what are the post-redemption effects? So for the treatment of the shareholders, this redemption is what they're looking for. It's treated as a sale. So if there are other amounts coming out that are being treated as dividends, those dividends are treated as coming from E&P first. If property other than cash is received in the redemption, then the basis in the property is the fair market value of the stock redeemed. When the redemption is treated as a dividend, then it's just treated as a dividend under 301. So first a dividend, then return of capital, then gain. The basis in the stock redeemed would then attach to the remaining stock. That's if it's a dividend. So X Corp has 100 shares of stock issued and outstanding. 80 are owned by R, 20 are owned by S. And R and S are unrelated parties. Each share has a basis to R and S of 1,000 and has current market value of 2,000. So in January of this year, the corporation redeems 20 of our shares for 40,000. So the question is, how will that redemption be treated for tax purposes to R? Okay, so 60 out of his 80 shares is 75%. That is not less than 50%. 75 divided by 80 is 93%. That is not less than 80%. Therefore, this is a dividend. So after the redemption, what basis will R have in those remaining 60 shares? Well, the old basis was 80,000, right? That's the $1,000 per share times 80 shares. So 80,000 is now divided by the 60 shares, or 1.333.33 per share. To the extent that non-cash property is distributed, the corporation is going to recognize gain on appreciated property, but not loss, just like it would a dividend. And that's irrelevant. That's true whether it's a dividend or a qualified redemption sale treatment. E&P is going to be reduced by the basis of the property distributed. And if it's treated as a sale, the reduction of E&P is limited to the pro rata share of E&P. So what that means is if the basis of whatever it is that was distributed happens to exceed the pro rata share of E&P, the reduction is limited to the pro rata share of E&P. Okay. So what about the treatment to the corporation? So in a redemption that qualifies for exchange treatment, which is sale treatment, the reduction of the rateable share of earnings and profits is limited. So A and B each own 1/2 of corporation X. X has 60,000 of E&P, and its net worth is 100,000. And X redeems all of A's shares for 50,000. Let's assume the distribution qualifies as a sale. The reduction of earnings and profits is limited. So in the absence of 312N7, it would be 50,000. However, it's limited to 30,000, preserving the 30,000 balance for treatment of future distributions to be. Right? So think about that. Because it had 60,000 of earnings and profits, even though the market value was equal to the $50,000, it does not matter. We're only going to release half of the E&P because that's the pro rata share of E&P that went out in the redemption. All right. So we're back to Gordon Gekko. And Gordon Gekko acquires 15% of Blue Star Airlines. And now Gordon's threatening to take over Blue Star. And of course, Blue Star management gets worried. And so to avert the takeover, Blue Star agrees to redeem Gordon Gekko's stock at a premium to the current price. This is called green mail. And under federal tax law now, there's a 50% excise tax on Gordon's gain. So what this did is effectively ended green mail. All right, so we once talked about a 1059E redemption. We're going to talk about it a little bit more here. So P Corporation owns 1,000 shares, which is 25% of the only class of stock of S. So in this case, I have a corporation that owns shares in another corporation. So S has earnings and profits and redeems all but one share of P stock for $1,000 a share. However, P retains an option to reacquire these shares for $8,000 a share. So the distribution is not an exchange under 302A because P is treated as continuing to own the 999 shares under the stock affiliation rules. So the redemption is going to be treated as a dividend, not a pro rata redemption. Nevertheless, under the above rule, there's an extraordinary dividend. As a result, they have to reduce their basis in S stock by the DRD amount. So we've already discussed the 306 preferred stock bailout. So I'm not going to go through that one again, which means we are at the end of Chapter 6. Thanks for watching.